Welcome to the Valuation Desk by Highland Global, where SBA business valuations speak bank. In this session, we're diving into a topic that trips up even seasoned pros in SBA lending. The difference between weighted average cost of capital, WACC, and the cost of equity capital. More importantly, why should you as a banker care? In business valuation, we use discount rates to turn future cash flows into today's dollars. The rate you pick depends on the cash flows you're valuing. Use the wrong one, and your valuation and loan decision could be way off. So let's break it down. If you're looking at cash flows to the entire business, before interest, before debt payments, that's enterprise cash flows, and you use WACC. If you're looking at cash flows to equity holders, after debt payments, that's equity cash flows, and you use the cost of equity. What's the cost of equity? It's the return investors demand for the risk of owning a piece of the business. For small businesses, we often build it up like this. Start with a risk-free rate, add a market equity premium, a size premium for smaller firms, and a company-specific premium for things like key person risk or customer concentration. Why so high? Because equity holders are last in line, after employees, suppliers, and yes, you, the bank. They bear the most risk, so they want a bigger reward. Now, WACC is different. It's a blended rate that combines the cost of equity, what investors expect, with the after-tax cost of debt, what it costs to borrow. Debt is cheaper than equity, and interest is tax-deductible, so WACC is always lower than the cost of equity when a business has debt. Here's the key. WACC and cost of equity are not the same when debt's in the picture. Let me show you with a quick example. Suppose the cost of equity is 20%, the cost of debt is 8%, and the business is 70% equity, 30% debt with a 25% tax rate. Take a look at the calculation. WACC equals 15.8% in this example. While the cost of equity is 20%, the blended WACC is just 15.8%. That's a big difference. Why is equity always pricier than debt? A few reasons. First, subordination. Equity holders get paid last in a liquidation. Second, uncertainty. No guaranteed returns, no interest, no maturity date. Third, volatility. Profits swing and so do equity returns. Fourth, asymmetry. Small businesses often lack transparency, adding risk. Fifth, taxes. Interest gets a tax break, dividends don't. Sixth, leverage. More debt means more risk for equity holders, so they demand more. No matter how you look at it, equity is riskier and risk demands a higher return. Mixing up WACC and cost of equity, say using WACC for equity cash flows, can inflate values and mislead your loan decisions. So, how do you stay on track? Always ask the appraiser. Are you valuing enterprise cash flows or equity cash flows? Make sure the discount rate matches. Why does this matter for SBA lending? This isn't just theory. Using WACC when you should use cost of equity can overstate a business's value, sometimes by a lot. That means you might approve a loan with inflated collateral, understate risk, or fund a deal that doesn't make sense. In SBA 7A lending, where collateral and risk assessment are everything, getting this right protects your portfolio and keeps you compliant. To wrap up, cost of equity is about what equity investors need. WACC is about the blended cost of financing the whole business. They're not interchangeable, and using them correctly is critical to spotting red flags in valuations before they become problems. As SBA lenders, your grasp of this difference strengthens your loan decisions and keeps your deals on solid ground. Thanks for joining us for this episode of the Valuation Desk. Behind every financial model and final value is a professional who knows how to interpret the story behind the numbers. At Highland Global, our depth of experience ensures that your appraisal isn't just technically sound, it's contextually accurate, SBA compliant, and thoughtfully reasoned. We've prepared thousands of business valuations and machinery appraisals, and we understand the details that make or break a deal. Because in lending, it's not just about the math, it's about the judgment behind it. For more information on valuation-related topics, be sure to visit our website, highlandglobal.com. Lenders know experience matters most.